Hello everyone, and welcome back to our derivatives course. Today, we'll look at an option trading strategy called the bull spread using put options. By the end of this lecture, you'll understand what it is, how to construct it, its profit and loss characteristics, and when investors use it. Bull spread using put options is a moderately bullish strategy that profits when the underlying asset's price rises or remains stable. It's constructed by selling a put option with a higher strike price and buying a put option with a lower strike price. Both options have the same expiration date and the same underlying asset. The strategy results in a net credit because the premium received from the short put is greater than the premium paid for the long put. It's a limited risk, limited reward strategy that earns income while providing protection against a large price decline. Let's go through the steps of building a bull put spread. Step 1. Sell a put option with a higher strike price which generates income. Step 2. Buy a put option with a lower strike price, which limits potential losses if the price falls significantly. Because you receive more premium than you pay, you start the trade with a net credit. The goal is for both options to expire worthless, allowing you to keep the premium as profit. The payoff at expiration depends on the price of the underlying asset. If the asset's price stays above the higher strike, both puts expire worthless, and you keep the net premium. That's your maximum profit. If the price drops below the higher strike but stays above the lower strike, you lose part of your profit, but the long put limits your downside. If the price falls below the lower strike, both puts are in the money, and you reach your maximum loss. Your maximum profit is the net premium received. Your maximum loss is the difference between the strike prices minus that premium. The break-even point is the higher strike price minus the net premium received. Let's walk through an example. Suppose a stock is trading at $55. You sell a $60 put for $6 and buy a $50 put for $2. The net credit you receive is $4. If the stock stays above $60, both puts expire worthless and you keep the full $4 premium. That's your maximum profit. If the stock falls to $56, the short put is worth $4 and your profit drops to zero, which is your break-even point. If the stock falls to $50 or below, you lose $10 on the spread but keep the $4 premium for a total loss of $6. This is your maximum possible loss. Notice that the profit line is flat at your maximum gain above $60, slopes downward between $60 and $50, and flattens again at your maximum loss below $50. It's the mirror image of the bull call spread, but it starts with a credit instead of a debit. Why would an investor choose a bull put spread? It's a great strategy when you expect the stock price to rise slightly or remain stable. You can generate income while limiting risk. It's less expensive and safer than owning the stock itself. From a Greek perspective, this strategy has a positive delta, it benefits from rising prices, positive theta, it gains from time decay, and negative vega, it benefits when volatility decreases. It's a good choice in low volatility, range-bound markets. In summary, the bull spread using put options is a limited risk, limited reward strategy designed for moderately bullish investors. It's essentially the credit-based version of the bull call spread, allowing you to earn income with defined risk. This concludes our discussion about the bull spread using put options strategy. See you at the next lecture.